Hello, everybody. If you are just joining us, this is Fresh Outlook. The global economy is on the decline. If you listen to the most recent forecast by the IMF, take a look.
In Ukraine.
This week, the International Monetary Fund downgraded its outlook for global economic growth, citing persistent weakness in the Eurozone and a broad slowdown in several major emerging markets. The IMF said it expects the global economy to grow by 3.8% next year, down from its July forecast of 4%. At an annual meeting of the world financial leaders this week, the IMF president said,
If the right policies are decided, if both surplus and deficit countries do what they have to do, it is avoidable.
In the United States, the stock market's recent meltdown has made many investors wonder whether there's a new financial crisis just around the corner. After a 6-day losing streak, the Dow was on track Friday to have its best day after such a streak since 2008. Economists say the hurdles around the world are not enough to derail a U.S. economy that's gaining strength from a stronger job market, falling fuel prices, and lower mortgage rates. Overall, America has surprisingly little economic exposure to the world's troubles. Exports account for less than 14% of U.S. activity, one of the lowest such shares in the world. On another positive note, gasoline prices in the United States have fallen to an average of $3.17, which is roughly the lowest price since 2011. Lower gas prices free up money for consumers to spend on other things, from clothing and restaurant meals to furniture and appliances that help drive growth.
Okay, you're back live watching us here on Fresh Outlook. I am joined by the Fresh Outlook think tank. They are Janie Feldman, who is a clinical psychologist. We also have Tom Prusa, who is a professor with Rutgers University, Paul Oster, the CEO of Better Qualified, and we also have joining us via live connection from Washington, D.C., Catherine Marshall from Georgetown University. And let's start with you, Tom. I'm going to ask you about this downgrade of the global economic forecast. 4% growth to 3.8% growth. To somebody like myself who's not an expert, you're like, what's 0.2%? It doesn't sound like a lot. Does it mean much?
No, I think in the big picture it doesn't. I think what it's hiding, though, are these differences across regions. And so the general downgrade, the forecast often are changed. But I think this highlights continued challenges in Europe. And that maybe for the United States, that's the main challenge for us. We need Europe to become more economically stable on a better path. And it's also reflecting slow in China. And again, for China's long-term growth, that's probably a good thing that China's
I'm going to stop you there for just 1 second and turn over to Paul. Paul, how is the United States faring? I know you are an expert in business and consumer credit. Are Americans doing better? Fewer people, apparently, if you were to believe the numbers, are out of work, or people just stop looking for work. What's your opinion?
I don't believe the numbers. So the unemployment indicator is one of the things that I challenge all the time. Is it that many less people have stopped looking for jobs, have taken lower income pay part-time jobs, or they just gave up because there's not that many new jobs out there? So we're doing okay, but I also think that we are not immune to the global, downturn. The last time we decoupled ourselves from the global downturn was in the 90s, but things were very different then. We're at the rock bottom in terms of long-term investment pricing. The 10-year was below 2% coming into Friday, and we now have more of our income coming from our corporations that are based overseas.
We're truly connected. In fact, those corporations are guilty in some cases of inversions, and a lot of people are trying to stop that. Let's turn to Catherine Marshall in Washington, D.C. Let's talk a little bit about the interconnectedness of the global economy. It's been a very, very good thing on some aspects. We've been able to share in low-priced goods that are made in regions that don't have the wage restrictions, I might put it that way, or standard of living that we have, and it's supplied us with cheap goods. But tell us a little bit about your forecast for the global economy and its implications for the United States.
Well, I'm not a professional forecaster, so I would hesitate to be more than generally optimistic about the trends that have happened. What I would urge is that in these hiccups, these sneezes, that are affecting the ups and downs, we not forget two of the leading issues that face our generation. The first is the rise in inequality, and all the debates that have taken place this year around the Piketty book, around Occupy Wall Street, the concerns about inequality. We need to keep those in mind. And the second is the world's poor, and the poorest countries, the bottom billion, those have to have a focus even when there are shifts in the world economy.
Catherine, are people who are poor getting poorer and the people who are rich getting richer across the globe, in your opinion?
Well, the answer is it's complicated, but generally yes. The gap between rich and poor, particularly in individual countries, is growing. What's also important, though, is that people can see it. It's in your face. When you're living in Liberia or Malawi or Laos, you can see exactly how the rich live and how the middle classes live.
Okay,
And the levels of anger are contributing to many of the problems we face today, including ISIS and other instability in the world.
A number of uprisings because of economic disparity. Here in the United States, we have a consumer-driven economy. Some people say up to 70% of our economy is driven by consumers, people spending money. How important are good numbers to the people from a psychological perspective, Janie, that people need to hear good news in order to feel comfortable to make big purchases?
Well, speaking just as a psychologist, my speculation would be that good news fosters more activity. So if you're feeling like in your community you're doing well, your neighbors are doing well, you might be more inclined to take some financial risks. But I'm not sure that there's always a reason for that. I think sometimes people just go emotionally rather than based on having actual factual information.
Let's turn to Tom Pruscia from Rutgers University. Tom, here we are, the third quarter of 2014. What do you think the big economic story is today?
Right, so just domestically, there's these two big things that the feature early mentioned. One is the falling gas prices. Are basically
Does that mean people are using less gas?
Probably not. That's probably not the case, right? The prices are high compared to maybe 15, 20 years ago,
Right.
but compared to recent experience, gas prices are down, and that in the short run likely leads to slightly more gasoline use.
Consumption.
But the main effect is probably going to be that there will be some money freed up to allow use in other areas. And the second big issue is probably an exaggeration, but the stock market's displaying volatility, that we had a long period of relatively modest volatility in the stock market. The recent month has had a lot more volatility, more like normal levels of volatility, but it's stirred up anxiety among people.
Well, certainly everybody was talking about it on late this week, about the fluctuations of the market. Now, Paul, I see you shaking your head a little bit when you say about gas prices. Again, why do you think the gas prices have dropped? Do you think it's actually a bad economic indicator? And because you are a consumer financial expert, do you think we're becoming a nation of deadbeats? I'll let you answer those questions.
Well, two things. I agree with Janie in terms of every financial transaction is based on emotion. Some level, how we feel about it, is going to determine whether or not we pull the trigger. The gas prices is, unfortunately, we're using that much less oil on a global level. So that drives our gas prices down, and it creates an artificial income because we're spending less. That fixed expense on gas allows us to spend a little bit more money on other goods. But all we need is a slight uptick in interest rates, and that's going to get washed out immediately. So.
Okay, let's turn it to politics a little bit, because in a couple of weeks, Americans will be going to the polls to elect possibly a new Congress, a new Senate that is Republican, because there has been a lot of bad press for the Obama administration as of late and the Democrats. Catherine Marshall, Washington, D.C. I know you're not a prognosticator of political elections, but tell me a little bit about your thoughts and how this election could impact what happens to our U.S. economy.
Well, when you work internationally, it's awfully difficult to explain the United States these days and the gridlock in our government. So the prospect of having an executive and a legislature that are completely divided and where there seems to be remarkably little will to repair the rifts and to find ways to work together and to make the society and the economy move in a positive direction. It's very discouraging and very worrying, and the rest of the world looks at it with, frankly, bafflement.
All right, Catherine Marshall joining us from Washington, D.C., Georgetown University. Thank you so much for your thoughts. Janie, final word on the U.S. economy, 10 seconds.
Going emotionally, I'm hoping for good things to come. Keeping a steady state would be a great idea instead of pulling funds from the market, just hanging in there because things will turn around and get better soon.
All right. And Tom Pruscia, what is your final thought?
Well, I agree completely with what Janie just said, which is I think the big mistake is to overreact to what's actually very modest changes in the stock market. Hold the course. Almost everyone will be happy.
Okay, and Paul, I'm going to give you a specific question rather than a headline. You deal with business and consumer spending and their credit. What kind of trends are you seeing for 2014 and beyond?
Unfortunately, the average consumer doesn't have the ability to come out of a bad credit situation. They don't have the money that it takes to, correct the things that may have happened. A slight hiccup on a credit report, a one-time 30-day late payment, can drive their credit scores down 50 points. That could ultimately cost them hundreds of dollars a month moving forward. So we need to do something about that for sure. And when you look at the bottom half of our households right now, their net worth is about $11,000. And she was talking about the inequalities. That's where it lies. So we need to concentrate on the fundamentals. Early and higher education efforts need to be strengthened if we're ever going to hope for a long-term recovery.
Okay, sounds great. Great thoughts from everybody. Our Fresh Outlook think tank. We're going to have a whole lot more when we come back, when we have our lightning round from Apple's new offerings to a sun that looks like a jack-o'-lantern after this.